Hello, folks. Welcome to State of the Market. This is David Russell, Global Head of Market Strategy at TradeStation Group. It's great to be with everybody. Today is Monday, June 9th, 2025. Going to start off by posting a few important disclosures into the chat. All right, so we have an interesting market here, which is essentially the other shoe is not dropping. All the things that people were worried about, the recession, trade wars, job losses, none of it's happening. And we have a market that's essentially just kind of melting higher. And we have some interesting things happening overall. I'm sharing these disclosures. And it was interesting last week to see how things worked out because in many ways there was no single catalyst. It was simply a lack of bad catalysts. The payrolls were healthy. And what's really interesting to me is that we saw industrials break out to new all-time highs, which was actually pretty interesting. And we're now seeing strength in things like global stocks, a diversity of things from kind of Chinese stocks to airlines. It's an interesting sort of setup. We also see things that the sentiment from the American Association of Individual Investors be extremely negative. And here are the standardized returns from the key ETFs we're going to be talking about. But this is essentially the kind of behavior that people might call a wall of worry, where essentially there's a huge amount of negativity. It's not panning out. There's a lot of people who are in a lot of cash, and now they're in a space where they need to take more risk to play catch up. And we're seeing, I think, that kind of dynamic take hold. We're seeing it play out in things like small caps that are starting to outperform the things like the NASDAQ. And there's very much a kind of activity to kind of see in an environment like this. We're seeing some kind of, I wouldn't say any kind of bearishness, but a struggling kind of fatigue in the mega caps we're going to be getting to. So it's going to be something of a broadening rally here, a little bit of a risk toward value, move toward value stocks on these kind of dash for values that we've tended to see in the last several years, and also a focus on cyclicals, some of the things that are economically sensitive. So I want to start off by going to tradestation.com. I want to show you, first of all, you go down the page here. This is the article that we wrote today that has a lot of the key points we're going to be talking about. You want to check that out. But also don't forget to go to Insights up here and go to Insights AI. This is our new page on Market Insights that basically uses artificial intelligence to track down and understand a lot of the things happening in the market overall. You can look at stocks that are outperforming or underperforming, and then you can see some kind of parsing of the different sentiment, the news, the analyst reports, all those different things. So you might want to check this out. Just remember that, with artificial intelligence, you still need to do your own research. These are some things that aggregate a lot of different news, but, we still need to be kind of always paying attention, making sure we actually do our due diligence. It's possible for AI to make mistakes. And so don't forget that, but you might want to check that out. You go up here to on the homepage of TradeStation, you go to Insights, and you go to Insights AI. But this is the article. There's our main focus for today. Industrials break out as risk appetite replaces fear. So I think it's interesting overall to actually see. I'm going to just show this. I mean, it's pretty interesting. Look at XLI. Who would have thought XLI? I mean, we had mentioned this incredible strength in XLI and this shift toward the kind of cyclical risk on. But it's interesting to me to see it's the first actual sector to cross above its pre-trade war highs. So that's interesting. It's breaking out to new highs. We're going to get to that. But I think the key thing here is that we're really in an environment, like I said, where there's a lot of cash on the sidelines. And it's almost like like a movie when people get like hijacked by terrorists or something, and then they get rescued and they cry with joy in the end when it's been so emotionally upsetting, and then they're just relieved that the nightmare is over. And that's kind of the way the market is here, where we've been in a spot where the intensity of the emotion to the downside has been so intense, and to a certain extent that has created an environment where now it requires something extremely bad for the market to go down again. And we're getting things that instead of being extremely bad are mildly bad. And that creates essentially an environment here. We're going to turn the S&P, but essentially it creates an environment where there's little selling. The volatility is very much under control. And we're seeing in many ways things take another kind of turn toward a weak dollar bullish environment where the American stocks underperform, global stocks outperform. And that in many ways is something that happened starting back in 2003, 2002, immediately after SARS, when China had a shutdown. And then we went on an amazing boom in emerging markets as American stocks underperformed the rest of the world for a few years, really about 5 to 6 years. And then, that was, it happened. And part of that was the global financial crisis. Not to say we have anything like that coming now, but we could be in a period, a multi-quarter period of American underperformance. And that doesn't mean it's necessarily bearish for the American stocks. If anything, it would more or less correspond to mild upside in American stocks. But then other certain areas, maybe value names, maybe small caps, can have a period of outperformance, emerging markets and things like that. And that's what seems to be what we're seeing here. So I would say, let's just start off by kind of going through the indexes. I think it's important to realize for a long time I've been saying that the 10-year Treasury was the most important chart. That might not be the case anymore. The dollar, to a certain extent, could be in many ways the most important chart here. But one of the things I am going to be getting to is that we are in a spot where we are seeing overall dollar downside, a shift towards cyclical stocks, smaller, riskier things, some value stocks, things like airlines, materials, industrials. We could see some of these beaten down retailers potentially also have, some value hunting them, especially things with China get better. We're waiting for some kind of news on China, Besant over in London with the Chinese. You can't predict how any of these things play out. Meanwhile, Apple is doing their AI thing, or not doing much of an AI thing, however you want to look at it. That creates this environment where the big mega caps, things like Apple, are just kind of sitting there, not doing much of anything. It seems like they're actually getting sold long-term, people shifting long-term gains out of things like Apple and going into these other areas. So it's a kind of distribution phase in some of the big mega cap names. And we could see that last for a while. So I think people have to realize here, we saw today also some interesting news with, what is it? Warner Brothers Discovery. Wow, it got slammed back down, but they had some kind of breakup today. But this is a sort of thing, a value environment. We saw things like Dollar General coming back from the dead. And we'll just point this out because this is an environment where the value things are outperforming, some of the comebacks are outperforming. And if we look at the other areas that we're working, things like semiconductors, Micron, MCHP, onsemi, these are all highly cyclical names. We're not even seeing outperformance in things as much, even like NVIDIA, or even things like, Marvell or AMD. We're seeing the outperformance in the more cyclical industrial kind of names, the lower valuation chip stocks, not the more high valuation ones. So I think all these things we're seeing overall are consistent with the sort of pattern of a shift toward value, towards cyclicals, towards smaller companies. We also are getting a bunch of IPOs. Now, I don't get into those much, but there are IPOs coming, which also shifts attention away from the large caps. And I think that's important to realize. It's interesting to look at things like JP Morgan here that are kind of just in these tight patterns. We did a trading view idea in this last week, but some of these more cyclical areas are potentially kind of interesting. I think we need to realize that. And then, of course, some of the stuff happening in metals. We've been talking about platinum, and platinum here is hitting a pretty significant high. We were talking about it back here when it started breaking out above this level across here. We did a trading view idea on it. We did a blog post on it. We talked about it. We've been talking about how platinum has underperformed for more than a decade. I mean, there was a time when platinum was over $2,000 and gold was $1,000. Now platinum is at like $1,000 and gold is over $3,000. So if you look long-term, platinum has massively underperformed. And it's exactly the same thing we're seeing in metals that we saw in things like stocks, where essentially gold is kind of like the mega caps, the Mag 7, and silver and platinum are kind of like the small caps. And now we saw, after a long period of yellow gold, yellow metal, gold outperforming, now we're seeing people going down the kind of market cap down. I won't say down in quality. I don't know enough about metals to even say it's down in quality, but you're going to an area that are less liquid, smaller markets, and people looking for outperformance, people who missed the gold rally, who are now looking to play catch up in silver and platinum. This is a very similar sort of pattern. Look at silver. I mean, we've been talking about this is now breaking. I mean, we don't normally look at things like silver in this webinar, but I think it's important to realize silver, platinum, potentially copper. Then we look at the dollar index, which we're going to be getting to, all these things just kind of languishing down there. So this is the overall pattern overall, and I think it's important to realize that. Now let's look at the things by the actual, by starting down our list. Now remember, in this webinar, we look at the key indexes. Actually, we're going to add dollar index to this. I'm going to get to this, but we start off with the S&P weekly charts mostly. We're looking at really like long-term structural sort of things to understand the state of the market in terms of the big sectors, the big indexes. We're not looking really at individual stocks in this webinar, unless they're maybe to illustrate something. Anyway, S&P 500 here. We were talking about this zone for a while, and we closed above it last week. And from my view here, there's really not much. You see this channel, this sideways kind of consolidation range back above it. And from my perspective, there's really not a lot of clear resistance before until we get to that all-time high. So from my perspective here, this is something where we could see this market kind of melt higher, and everyone says how terrible it is. They say it shouldn't be happening, and then it happens. And I think that's one of the things that you have to realize about a market like this is simply that we've gotten to a point now where there's so much negativity baked in. People are just assuming we're going to have a worst case scenario outcome, that then when you wake up the next morning and the world is still there, well, then, people have to put money to work. And that's kind of what is happening here. So I think it's important to realize the market can go through these strange sort of periods of hyper negativity that then morphs into something more positive, and it can sometimes morph into extreme euphoria. And this is potentially the sort of environment that could see, a melt up that actually gets, potentially more irrational and more kind of surprising. I've been watching these things for a long time. Now, it's interesting to look at the Qs, because in a way, probably not a huge surprise, is that the Qs here are kind of like, they're doing a little inside week. But look at the S&P. The S&P, wait a second. The S&P is above last week's high a little bit. The Qs are still inside of last week's range. Okay, so it's a little bit of inside action. So from my perspective here, this is kind of what you'd expect in this environment. We are seeing small caps outperform. We are seeing a shift toward equal weighted things, towards smaller companies, towards cyclical companies. The Qs, the large caps here, are becoming a source of funds, and they're getting kind of stuck as people shift towards smaller things. So I think it's important to realize that here, we could be in a period where the Qs are not necessarily bearish, but they could potentially just kind of stagnate and drift for a little bit here, especially with Apple just kind of, not doing anything all that amazing. And a lot of the other, large names like Microsoft and shooting to a new high. And now, when you look at a name like MSFT, Microsoft goes as new high, and of course, there's nothing on this chart that you say is bearish, or people might look for more consolidation on something like this after a move of this nature. See, it also has not gone above Friday's level. It's pretty, this is something where people might say, something like Microsoft here, it's had a strong run, things like Apple also. So I think it's important to realize when we look at these names overall, this is an environment here where we've seen this behavior before. When people go to small caps, they go to industrials, they go to financials, they go to emerging markets. And if they're going to those things, then in many ways, it means that often they're going to be going away from the big index names, which is essentially the NASDAQ 100. So I think it's important to realize that. And we're going to get to the Russell in a second. Let's look at the Dow Jones Industrial Average, DJI. Now, this one is interesting to me because from my view, also kind of escaping here, and the levels from late February, beginning of March, up just under 44,000 might be the sort of level people look for on this. We see this level we have marked out here, but I'm going to remove these arrows now because I think we're kind of potentially breaking out. Like if we went up, hit that level and came back down, that'd be one thing. But this level now looks like it's kind of fading as resistance. I'm going to leave it on the chart just now for a reference point. But I think right now the focus here could be that level from late February, early March. Now, the Russell is the one that's most interesting here. What's interesting is last week, the Russell, it did slam down. But then guess what? It had a bullish outside week and it came ripping back. So here we are in a spot where people might really see some space in this. So, if the Russell goes back to its levels from late February, that is still, pretty far away from where we are now. Now, this I think is very important. Bullish outside week, close above that resistance from this period back here in late March, right before this was the Independence Day tariff, or whatever you call it, Liberation Day tariff sell-off, and then got above those levels with this space up here. So this is, I think, something people might look at. And I want to show you also the Russell against the NASDAQ. There's a ratio I like to look at, not too often because it's kind of a big historical thing, but this is the ratio of the Russell against the NASDAQ. Now, you basically see this was the dot-com period when the NASDAQ outperformed. This was the bear market of George W. Bush's presidency, basically between 2000 and 2000. Well, actually, this was 2007, right around there. Was that I was always thinking about it as the Bush kind of it was the non-tech, coming out of 2001, September 11th, all these sort of things happened through here. This is a period when emerging markets did well, when financials did well, retail and tech struggled. The key thing is this is a Russell against the NASDAQ, and you can see that after this rebound, it had a long period of underperformance. And, it's not to say that it's going to rebound that significantly, but if you look at it, it's basically hit pretty near an all-time low. So from my perspective here in an environment like this, people might look for a period of a few weeks, something like that. But the key point of this chart is not to say that the trend is higher, which it isn't. It's to say that people could see some, you can see it makes counter trend moves even in its worst moments. So the fact is that if this had some space for a counter trend move, is exactly what I just said, of the NASDAQ underperforming and then value outperforming, small caps outperforming. And that seems to be, when you look at this index here of the Russell on the weekly here, it's above last week's high, and the Qs are not. That's what we're talking about. And that's essentially here what this chart I think is important here. So from my perspective, I think, people might still be kind of focused on this level from back here, late January, early February. Now, remember, the Qs, in contrast, have already reclaimed those levels on their respective chart. So that's kind of the main point I want to make about that. Now, the dollar index remains highly important. If we look at the dollar index back here, this is when the market was bearish and people were just freaking out, selling treasuries and, unloading on the US dollar and all that. And that was disruptive and kind of, pathological. Now we're in a period that is way more kind of risk on, global. And in some ways, I think it's important to realize this was a fast and kind of very panicked decline. But now we're at a spot where people might look for a more steady, move lower. And I think it's important, if you look at the dollar here in the long term, you can argue that there is space here to the downside. And if that's going to remain the case, things like metals could really have a period of outperformance here. Gold has moved, but it's silver, platinum, and the other one is copper, which, let me see, it's XCUUSD on this. Wait a second, I got to remember what my copper even is. I mean, copper here is not as necessarily as constructive. But I think the thing is that, you can also look and see that this is also something that has a sort of degree of, association with China. There's only a few names here, but we're going to get to the XLB, the materials. But this is kind of consistent with that essentially here what we are seeing is the dollar just kind of limping and struggling. Now, I think the other thing to realize is that the Fed has not been interested in cutting rates. They've been pretty much saying we're not going to cut rates, or however you want to view it. We have seen a hawkish move in the Fed, and or at least an anti-dovish move in the Fed. Other central banks, Europe and others, India /50 basis points. The rest of the world's been cutting rates and the dollar's been going down. That's kind of interesting here. So I think in some ways it actually says what happens if the Fed does start to cut rates. Then, that creates, I think, also a degree of downside here. And I think right now I've been saying that we had reached peak hawkishness about a week or two ago. And now we're seeing the sense of the hawkish worries fading. And I think we're in that spot where there's a lot of worries here about the Fed being hawkish. And if we start moving back toward the direction of talking about rate cuts and expecting things like that, we could be in a spot where the dollar moves lower and it's more of a blissful sort of weakening instead of a panicked weakening like we saw back here in the first part of March. I think that's an important way to think about this. And, I think it's not to say, the dollar just goes crashing down under 90, but it creates a potential here for the dollar to just kind of sputter down. And as that happens, we could see those weak dollar trades like those metals really make, that's where people could be focused in a period like that of dollar weakness. Now, the 10-year treasury yield on this chart here, in my view, is now like completely just stuck. It has held this level, but we pointed out this zone across here. And, we've been saying that I think that the people forget all about the fact that home prices are coming down in the United States. And shelter is a big chunk of CPI. And we've been saying it many times, but I think we have to realize here we're in a spot where tariffs create some risk, but we have a structural positive thing happening in terms of inflation coming down. And I think right here we're in that spot where we have to see, but I think right now treasury yields are truly neutral. And this is kind of what, if they are going lower, if they're going to go lower, this is what you'd expect. You'd expect to see them try to hold the low. They're going to bounce there because that's that key level we talked about, 432, talked about it for over a year now, and we're holding that level from all the way back at the beginning of the financial crisis. However, this level, like we said back here, in early May, we said 460 to 465 was the level, the zone we were watching. We hit it and we stopped. And now I think we got to wait and see here. But this, in my view, is something where if you look, this is not, if you want to look for yields to move higher, you're not really liking what you see here. Look at how essentially this had a false breakout above this level from April of 24. And we went above and couldn't hold it. Then we hit resistance below it. And now we're basically just sputtering here. But when things want to break lower, this is what they can do. So I think we have to realize that if the Chinese situation more or less is resolved to a satisfactory, kind of outcome, people might see this just kind of break lower. And then we start talking about lower inflation. We start talking about maybe the Fed's going to do this or that. And so I want to just point that out because I think, like I said, we might have hit peak hawkishness, and then the follow through of inflation coming down and housing and stuff could start to kick in. So that's the 10-year, and that's why I think also right now the 10-year, could matter less, but also if the 10-year yield moves lower, that would also favor small caps. So XLB. Now, we talked about the potential for this to have a bullish triangle breakout last week, and that's more or less what's happened. And now remember, XLB Materials has that potential to benefit from a weak dollar, and that seems to be what's happening now. So from my view here, this has really not a lot of resistance up toward, this is when people might look for 91, but even then, if we get into a period here of dollar weakness, this is a small sector. These are little companies that people don't have much exposure to. And those are the kind of things that have that potential to squeeze upwards. So from my view here, something like, even a move toward 91, people might really be looking for this to be going to new highs, especially if industrials are hitting new highs. They're kind of related. All right. XLC Communications. We've talked about the overall strength in this. But the problem with this is not a hugely cyclical part of the market. This is a secular growth area. Things like Meta, Google, Netflix, those big names. And they're, you can say they're good companies. So the problem is that everyone owns them. And if you want exposure to a weak dollar and you want exposure to a cyclical economy and you want all that, then people are not focused on things like XLC. So from my view here, this has the potential to kind of stagger and become a source of funds very much the same way the technology and the NASDAQ appears to be doing. Now, energy is one that has been very kind of confusing because of geopolitics. However, there could be a spot here where, I'm not sure what to make of it, but it looks like there's not really going to be much of a deal with Iran. So we could just kind of keep this kind of lingering tension in the Middle East. Meanwhile, if we get, a deal with China or some kind of resolution so that the economy doesn't go into a recession, then we're in a spot where people could look for energy to move higher. So from my view here, energy has this spot where, it has not been able to break lower. And so from my view here, this is something where people looking for that cyclical sort of theme. If you say, I think we're not going to be in a recession, the economy is going to recover, something like energy is an area here where people might look for a move back up toward these highs. I think in many ways, the kind of late, the highs of February and March on a lot of stocks, a lot of charts are becoming reference points. And the fact is, the Qs already went back to those levels from earlier this year, from like February. Energy is nowhere close to those levels. And so people might simply say, this has potential, in terms of the fact that we haven't gotten there yet. This is now, like I said, if we're in a value market and we're in a sort of a market when people are looking for comebacks and they're no longer looking for just like those kind of massive growth names, that are just, consistently streaming to new highs. They're looking to buy stuff that's cheap, that's going to come back. That's a different sort of thesis now, when people are going to look for these old levels and say, you know what, something like this still is well below where it was. And if the tariff thing goes away, then this needs to kind of go back where it was. And that's how some of the reasoning can work out. And I want to just point this out because I think it's interesting to look at those reference points from before Liberation Day and see how far away we are from them. Now, the financials here, I think that the financials have become an increasingly kind of complicated sector, because the property and casualty names have gotten, there's a lot of names in here that are way less cyclical, and they're way more like kind of counter cyclicals. Like property and casualty and security firms have nothing to do with each other in terms of their performance, in terms of their theme. Financials here remain an interesting spot, but they're also a little bit like communications here and a little bit like technology. So I want to kind of point that out, that this is kind of drifting here as well. And, from my view, this is, there's nothing you can say about it that's bearish, but people could see this. Look how tight this is. And this is something that could have like a false breakdown and some kind of small little knife downs. Like people might look for it to go down and chop down these levels, like under 50, somewhere across here, and then buy the little crash. So this is something that's totally range bound and drifting and doesn't, in my view, offer much of an edge. But now the banks are a different story, because if we're looking, this is the BKX, the bank index. We did a trading view idea also on JP Morgan. A lot of these banks look very similar, but look, what do we see in this one? We see this one is above the recent high. This is potentially setting up for a breakout of this tight range. And so from my view here, if you're looking for something cyclical, if you're looking for yields to come down, if you're looking for small caps, if you're looking for value, if you're looking for the world returning to normal and no recession, then something like the banks make more sense than something like the financials, when you get Berkshire and you get Travelers and you get Moody's and you get these big names that are just, no one really knows what to make of them. They don't have that same thematic meaning that you're going to get from the banks and the financials. That is the XLF. Now, industrials XLI here, I mean, it's pretty interesting. From my view here, this is, it's broken out, but still, when something closes at a new all-time high, it can easily have a week or two of downside. From my view here, people might want to see if we get any kind of stab down toward like, this area on 144, and not much to the downside, but kind of chopping down inside this candle a little bit. But from my view here, people might want to look for something like the XLI, just to chop down here in the daily chart, just kind of a little, see if we kind of get down into this zone that I was thinking about, down like the close from Thursday. Something in here people may be buying. What I think is interesting, though, is look at the airlines. We did a trading view idea today on Delta. I actually wanted to do an idea that was more negative last week on American Airlines, and it just refused to confirm. And, Mark Douglas, he says, keep your mind open to the now flow of possibilities. And this actually seems to be what's coming together now, which is that essentially these airlines are kind of squeezing off the lows. I say it because airlines are industrials. And this is, I think, right now with industrials breaking out, they might, the XLI might not do much of anything, but the airlines might do something. So I want to point that out. Now, XLK technology, very similar to the Qs here. I think we got to realize that this has not broken out, and it's pretty close to its highs. So it's not bearish, but it is at a risk of, if things get kind of choppy, that it could have a few slam downs, and it could maybe just sit here for a little while. And I think it's important to realize we're also getting near the end of the quarter. We have the Worldwide Developers Conference today, but I don't think there's a lot of huge, more important events. So we have a month kind of until we start getting month and a half until we get it to these earnings. So this could be a period of kind of, drift in the big caps, and the small caps give some outperformance. Let's take a quick look at Apple, because Apple here also, they had the Worldwide Developer Conference. I'm not sure what Tim Cook said, but the expectations are pretty low here on Apple. And I think this is a name here where, I mean, there's a reason to think that Apple might be done as a stock. I think we have to realize, or as a great growth name. because we have seen market share losses overseas. They have competitors they didn't have before, and they are also lagging in the new growth area. And, Tim Cook has been good at a lot of things, but he's not really an innovator. And I think we have to realize is that there's a chance when you look at it institutionally that Apple simply has gotten behind the curve on stuff like AI. And that's not necessarily going to be something where they just come shooting back. And it looks like right now these Chinese competitors are doing pretty well. So I think we have to realize here is that Apple might be kind of trapped and challenged for a while. And that would be a challenge on the XLK. Consumer staples here. I mean, from my view, if we are in a bullish sort of market, this might have a little bit of potential from the value perspective, but this is something here where this range doesn't give any real opportunities. And if anything, it does create some risk of something taking, kind of bleeding lower. If the market starts to, if things get overall bullish, consumer staples can actually struggle in that environment. XLRE, now REITs, I mean, from my view here, we have to see if we can get above this trend line or even some of these levels over here from like March. From my view, some potential for weakness in treasuries is okay for these guys. My expectation, if you look at overall, the likelihood of yields just knifing lower might not really be all that strong. I want to kind of point this out that this is an area also where kind of like utilities, people probably want to see a breakout of the flat line and not a trend line. So, I mean, that might really mean we need to see more of a breakout above like 45. And it's not that far away, I think, when we look at it overall. So from my view here, something like REITs are, potentially in a spot where the chart gives us a lot. Well, they give us a lot of confusion and not much of clarity or not many real signals. Utilities here, in many ways, are in the same spot. We had kind of mentioned a breakout above 84 is what people will probably be looking for. These are non-cyclicals. These are kind of boring, safe havens. And honestly, with some of the stuff I can see in this new, kind of the big, beautiful bill, however this thing comes out of Congress, this budget thing, it seems to be taking some incentives away from green energy. So on one hand, utilities have benefited from the AI, nuclear energy, electricity demand, all that. However, a lot of these companies also have varying degrees of exposure to investments they made in solar energy products and stuff like projects and things like that. And, you'd have to be some kind of like hardcore CPA to go through and understand it all. But I think the key thing is that these are an area here where they're not cyclical. They're not very, kind of risk on, and they have potential regulatory, legal, fiscal, tax credit, whatever kind of risk that's drifting out there. So I think we have to realize your utilities have not broken out, and they might be like consumer staples where, they might just sit and drift and then actually potentially, go back down and maybe form more of a longer term range here. So from my view here, this failure to break out in the XLU is not really particularly bullish signal. Now, healthcare is a little different because we're seeing some strength in biotechs recently. And we did a trading view idea on the XBI, which is a biotech. And you can check it out. But I think this is kind of interesting also. These have lagged for a long time. They have some risk on potential. The other thing about healthcare is that, things like United Healthcare got really hammered not that long ago. And people who are looking for value might actually look in this area. So I think healthcare here, even though it is a safe haven, in this environment when there's been a lot of selling and a lot of carnage, people might actually look in this area. And I think the thing that's important to realize is that here's a low, from back here in basically October of 23, and we seem to have kind of held above it. We probed down to this level in April, then we came down. Also, we had a false breakdown under it in May. And so this now could, this level around 130 could potentially be our new low here. And so people might look here for healthcare. And for a long term, I mean, I hadn't really noticed it before, but, you could potentially put a trend line here. So I think we want to just kind of realize here that healthcare, I mean, not a very strong trend line, but we have kind of on the longer term time frame here. Here's 2022, 2023, 2024. So kind of these lows on the annual basis. Not to say it's screamingly, bullish, but people might actually see here some overall something to look for some, strength. The last thing is consumer discretionaries are actually pretty interesting here because they gapped up. And we had kind of mentioned the fact that this level, was appearing to be more substantial resistance. But now we're also at a spot where it's held here. It hasn't broke back to the downside. Tesla, at a certain point in time, the pendulum could swing the other way. The whole drama over Elon Musk and Trump and all that stuff could fade, and we could start talking again. Oh yeah, Tesla has robo taxis coming out, and what happens if Elon Musk turns his attention back to Tesla? What happens if they start releasing good vehicles again? What happens when the robots start coming out? All these things I think are out there. The robo taxis, all that stuff. So I think at this point, Tesla is in many ways the stock that seems to move the XLY consumer discretionary ETF. Also, Amazon here is in a spot where, it's also a cyclical stock, but it could benefit, potentially from a situation with China. The stock at this point, it kind of held this level, and people might look for Amazon to move back up toward these highs around 240. And if that's the case, something like consumer discretionary is going back over to this chart on the weekly. This could be something where people could look toward, kind of up toward these levels. So I think from this perspective here, this has now kind of played itself out. And if the risk on cyclical, no more crisis sort of thing continues in that direction, then consumer discretionaries are actually a spot here where people might look for, more of a squeeze to the upside. So want to kind of point that out. So it's great to talk to everyone. We will see you on Thursday when we do market trends. So everyone has a great day, and we'll see you then. Thank you very much.